Good morning, everyone, and welcome back to the Money Mental podcast. I am stepping in for the lovely Graham, and as always, we have the amazing Doc with us. How are you?
Yeah, I'm good, Lexi, and it's nice to see a prettier face than Graham's. I'm only joking. Graham's actually superbly beautiful, but he's a busy man, and it's good to have another fresh face on the podcast. So I'm looking forward to a raft of insightful questions from you today, Lexi. Only joking. I don't want to put any pressure on you. But
I'll throw some at you.
Oh, that's good. Excellent. I like questions. And but we've got a lot of interesting information today, a bit on the economic side, but we did have some important economic data released last week. There was a lot of chat, as usual, in the media as to its importance and implications. We'll sort of go through that. As usual, we'll have the weekly auction report. It was an interesting weekend last weekend with our auction markets. They actually looked like they just tracked back. Well, they didn't look like it. They actually did track back slightly over the second weekend of spring. So is this a trend, or is it just maybe some distractions, football finals, etc.? Yeah. But the results nonetheless were still strong or, certainly robust. So but the spring market marches on this weekend again, and we'll see whether that slightly weaker performance continues or whether it will bounce back again. But we've had a very strong year so far, a strong winter for the auction market, relatively speaking, which followed a strong autumn. So, perhaps there's a little bit of buyer fatigue happening there, but all will be revealed. We also have the rent report today. So we're going to look at the August rent report, hot off the press. Interesting news there and lots to discuss. Not good news for tenants. We say that every month, more bad news for tenants with the rent report. But we actually had some remarkable results in the rent report, not so much from rents, which continue to rise, but from vacancy rates, which really plunged from already very low levels to even lower levels over August. And we've got some reasons behind that. So have I given it all away? Do we need to do any more? Well, we do. So perhaps we'll get going.
Sounds good.
All right. So My Housing Market is my brand. We work together within the Infinity Group, of course, and we provide the current state and future prospects, or insights into the current state and future prospects of housing markets. And, of course, it's important to have that latest data when you're making your decision about property, buying or selling, or just thinking. And that's what we try to do here at My Housing Market in conjunction with the Infinity Group, is to give you the latest data and put together all those pieces of the jigsaw and come out with some, robust and, we believe reasonably accurate commentary going forward. So shall we start, Lexi? We shall start.
Yeah, let's do it. I'm excited.
So last week we had the GDP numbers. Of course, that's the measure of the economy. The ABS measures the economy every quarter. It's a little backward looking because this was the June quarter, and of course we're into September now. But there's a lot of measurement that has to be done when we're looking at the economy, so it does take some time. But we did get some interesting results. GDP, gross domestic product, which is a measure of the performance of the economy over the quarter, rose by 0.4%. That's around about where it's been, what it's been doing over the past couple of quarters. So a reasonable result. Let's remember that there's been a lot of predictions through COVID and then with higher interest rates that we would get a recession. And a recession is measured by 2 consecutive quarters of negative growth. So if we had have gone backwards in March and then backwards in June, we would have had a recession, doom and gloom. Right. But once again, those forecasts of a recession have proven to be well wide of the mark. But it's an exciting headline, Lexi, recession. got to read that. And of course, financial journalists love to run with that.
Of course.
And they had a little bit of an opportunity to do that. And we'll discuss that in a second. So GDP up 0.4% over the quarter, 3.4% over the year. So that's a reasonable result. The economy grew by 3.4%. It's doing around about the same quarter to quarter currently. This was the seventh straight rise in quarterly GDP. Annual growth remains above trend. And of course, that reflects the absence of those COVID lockdown implications or, imposts into the economy. Capital investment, spending by governments and exports of services such as travel were the main drivers of GDP over the quarter. It was interesting. We could have actually had a better performance with our economic growth, but we had resource prices were actually down. Global resource prices were lower over the quarter. And of course, we know Australia is a big exporting country. We get a lot of income from our mining exports, particularly iron ore, coal, etc. But those prices fell away a little bit over the June quarter. And that impacted our GDP because we didn't get as much income, even though our volumes were still reasonable. We didn't get as much income because prices were lower. So if we had actually had the same sort of performance in terms of prices on our resource sector, we would have had an even better performance. So it's not too bad, given that we had that weaker performance from resource prices. And of course, the reason resource prices have started to ease is because we're back to normal, more or less, following COVID. Shortages of supply. Demand is now caught up with, or supply is now caught up with demand, and that's why we're seeing lower prices. The other thing that was interesting out of the GDP data was that the savings ratio, so the ratio of savings to incomes, it fell for the seventh consecutive quarter. So that's how much savings we've got, down to 3.2%, which was the lowest level since the June quarter 2008. Now, no surprise here. We've seen savings go from record high levels of the savings ratio, as we saved all those handouts we got through COVID. But of course, we have inflation running still at the highest levels that we've seen overall for decades, even though it has improved, and higher interest rates. So they're, of course, going to mean that we're going to have to dip into our savings to cover those higher costs and higher mortgage costs. But no surprise. The Reserve Bank would be happy to see that because that's what we want. We want to see less spending. And the more we spend of our savings, the less discretionary spending we're going to be encouraged to do, because we haven't got a lot of savings. We're just going to concentrate on the essentials. So that was the data for GDP that we had. When we look at the trend there, we can see it's reasonably steady and flattish. Not flat, but certainly steady, the quarterly results up to June. And when we look at the annual results, similar scenario there with the annual results. So nothing to get too excited about on the negative side or the positive side there with our economic performance. But as I said, it is backward looking. It's telling us what happened over the 3 months to June, and we're now into September. But now it was interesting that there's another measure that some of the financial journalists and the commentators have picked up, Lexi, in terms of the GDP, and that's GDP per capita. All right. Oh, yeah. So that takes the measure of Australia's economic performance, and then it divides it by the number of people in Australia. Oh, yeah. So it's per capita, right? Mm-hmm. GDP. Now, hang on to your hat, drum roll, scary stuff. Woo. We've actually had a GDP per capita recession. Right?
Oh wow!
Yeah, wow. Are you concerned? Yeah. No. Well, you shouldn't be, because even though there was a lot of hey, we've got a recession sort of headline out there with a few that were a little bit disingenuous. Let me tell you, But it's, any time you can get that recession headline out there, it's good news because guess what? Clickbait.
Absolutely. Yep.
Right? So we did have our second consecutive quarter of lower GDP per capita. Now, let's have a look at this to just examine it because it really is reasonably irrelevant. But let's examine why we've had this consecutive period. Now, if you go back to pre-COVID, which of course is, if we go back to there to 19 and 20, we can see that our levels of GDP per capita were actually a lot lower than what they are now. And that's because we stopped importing people because our borders were closed, right?
Yes.
So our economy was still growing. We were, up and down a bit because of COVID lockdowns, but still we had a lot of stimulus packages which offset the lockdowns. And that built up that per capita GDP number because we weren't getting the people coming in, but we were still growing. So, per capita GDP gone through the roof. Beautiful. But guess what's happened over the last 12 months, Lexi? People are back. They're
coming back. Yeah.
They're here. They're back, and they're back in really big numbers. So, of course, that means we've got more people, and that means we have lower GDP per capita. And it's a very unusual situation because we've had this surge in population growth migration. And that's acted over the last 2 quarters to push down GDP per capita. So I hope that makes sense out there.
Yes.
It's not doom and gloom. It's actually pretty good because if you look at how high our GDP per capita is now, compare it to where it was pre-COVID, and you can see, we're doing very nicely, thank you, on that particular measure. And the only reason it has fallen over consecutive quarters is because we've had a flood of migrants, unprecedented flood of migrants coming back into the country. That's pushed up that's pushed it down, and it's a sort of an offset to what happened when they didn't come in, when the borders were closed. So I hope that's as clear as mud to everybody. But I think if anyone was concerned about those headlines, this is, of course, the counter argument. Well, it's not an argument; it's just the facts going forward. And it's any talk of a recession when we have 3.7% unemployment rate. Is a little bit misguided in terms of doom and gloom. I'm not saying things are great out there everywhere, particularly with higher interest rates, but everybody's basically got a job if they want one at the moment. Absolutely. And wages are rising, reasonably strongly. And the last time we had a real recession, which was the early 90s, we had unemployment rate over 10%. Yes, 10%, not 3.7%. So if it is a per capita GDP, something to get really scared about, which it's not, it's not reflecting in the other big picture. So I thought we'd put that one in as a little bit of an interesting economics lecture for those out there and those that are sitting there trembling with the prospect of a per capita recession. Don't worry about it. Get on with life.
Doc, that's awesome.
The other thing that's interesting, Lexi, a bit, which we get back into sort of more of the housing market now. And, of course, when we talk about GDP, et cetera, it's about confidence big time. If people start to get worried that there's, a recession happening or about to happen, they, of course, will postpone their buying and selling decisions,
Absolutely.
Now, this can be appropriate in the appropriate circumstances, but they're certainly not those circumstances at the moment. In fact, quite reverse. Our economy is performing quite well. So house building costs. Now, Lexi, we run a house building cost index here at My Housing Market because we know that house building costs have gone through the roof. Is that a pun? I'm not sure. But
no roof yet.
Well, that's right. If it was a roof, they would have gone through it, right? So the national, when we look at the index, that it was actually steady over July. So that's the quarterly building costs, and this is derived from ABS data. But they certainly remain significantly higher compared to the same period last year. So we can see that growth rate has just started to ease a little bit. This is the quarter-by-quarter growth rate, well ahead of where it was a year ago in July last year. But just tapered off. It has been tapering off and tapered off slightly. So it was flat. So that's sort of good news, is it not? Well, not really. When we look at the next data set, the rate of annual growth, so that's measuring the growth from July quarter last year to July quarter this year, it actually increased. Even though the growth over the quarter flattened, the annual growth was actually higher. Now, that's the first time we've had an increase in annual house building costs, right, since May 22. So,
wow.
It looks like, and this is the problem, that we have had a consistent easing in house building costs. I mean, you'd have to, because it was running at around 23% per annum at one stage, which is crazy stuff, and it's all because of the stimulus packages that brought a lot of people into the new house building market. And of course, there weren't enough tradesmen and materials to cover it. So, prices went through the roof. And that's been one of the reasons why Australia's inflation has been a little bit higher, or a lot higher than in other similar economies such as the US. So those results are still high. Growth has resumed quarter to quarter. It was a sort of a quieter quarter, July last year. So, we need to keep watching the trend as it emerges. But of course, there's no doubt that, that's continuing to push, put pressure on home building profitability, because there's no real significant sense. The latest data is not showing us the continuance of the easing. And even if it had continued, it's still growing at 11.8% there per year. So house building costs are still higher by 11.8% compared to July last year. So that's a pretty big gig in terms of management for builders who are trying to make a profit. And you can see when we look back to pre-COVID, it's just a couple of percent typically house building cost increases. And that's why builders can use those what were predictable increases in house building costs, to make a reasonable living and make a profit. But how do you do that when costs are running as high as they are now? But as I said, the bad news is that for the first time since May last year, we actually had an increase in the annual rate of house building costs. Now, as I said, we need to keep watching this trend, but it's not sort of falling sharply as it has been sort of recently. In fact, it's been leveling out. So it looks like we're stuck with, certainly at the moment, around that double figure growth level in house building costs. Anyway, so that's interesting, of course, because it just means, again, that we're going to have trouble building houses.
Absolutely.
And
Doc,
that's
what happens if it stays the same, like if it levels and doesn't keep going down?
Well, it means that, smaller builders are going to struggle. Perhaps the bigger builders will struggle too, because they have to absorb those costs. And it means that fixed price contracts become problematic, because you can't sort of focus on how much the project's going to cost, because you're getting these, like 10% increases. So it means, in a sense, rise and fall contracts. But at the end of the day, it means you just got to pay more for your house. The end result is the consumer has to pay more for the house. So, higher prices. This is the point. And it'll mean fewer houses, because builders will be, will be certainly over the shorter term constrained with their profits. And even if they can get a building approval, they're going to have trouble, getting it out of the ground, because they can't trade unless it's profitable, So even the building approvals that we get, and they're at low levels, are not necessarily going to transfer into the same level of commencements that we typically see from approval. So, of course, the whole big picture here is we've run out of houses. And on the supply side, we're not fixing that up at all. In fact, we're going backwards. And this is another factor that's constraining our desperate need to find more houses, and of course, that leads us quite remarkably into the proof of running out of houses. And that's the latest home rent report. So rental markets have tightened over August. We know this has been an ongoing trend. We've seen rents rise periodically by strong levels. They're up remarkably compared to a year ago. And even though from period to period we could see a little bit of easing in rents, that's only because people can't afford to keep paying an extra $10, $20 a week in rent, because they just can't afford it, because they sort of plateau at their affordability level and then they have to wait a couple of months till they can save, and then they can pay the extra 10, bucks a week, 20 bucks a week rent that's being asked. But rents are just horrific at the moment. But what we did see, which I think is very interesting over August, Lexi, is that the rental markets tightened. Now, they didn't tighten so much in terms of higher rents, which happened anyway, generally, but it was the vacancy rates fell sharply, again, to record low levels. And as I said, generally rents also increased. Now, when we look at the collapse or the sharp decline in vacancy rates from already very low levels over August, the reason from my perspective is, of course, that August is the beginning of the second half of the higher education year. So that's when we have, students back at uni after the mid-year break. And what we've seen, and the latest data coming out has revealed that we're seeing absolutely remarkable numbers of international students coming into Australia. And they are obviously a key demand driver for units, particularly around university sectors in our capital cities. And I think this is one of the reasons why we've seen this tightening of vacancy rates over August, is reflecting that high demand from temporary visas students for rental accommodation as they start their university year, their second part of the second half of the university year, whether it's third semester, second semester, whatever. And I think that's a reason why we can look for why those vacancy rates fell. And just on the bigger picture about the rental market, which is, chronically undersupplied and really the prospects of an improvement are really nowhere in sight. And that's being kind, I think. I think it's, mission impossible, to be quite honest. Where's Tom Cruise when you need him? But we need him in the rental market. But the prospect of rent freezes, which of course was bandied around, the Greens were like, we're going to have a rent freeze. That'll cure everything. Love us, vote for us. We're going to freeze your rents. Well, thankfully, a couple of weeks ago, governments met and they said, nah, that's a joke. We're not going to have it. It'll only make things worse. We've spoken on the podcast here a couple of times that the Scottish government tried that one last year. They've now repealed it, and the impetus for the repeal actually came from the tenants, because they said, no, this is bad news. The rent freeze is bad news. It ruins our reputation or our relationship with landlords, and also it ends up with higher rents, because you can't freeze them forever. And they just catch up, and landlords then are less inclined to be, I guess, have a positive relationship with their tenant, because they've just got to catch up after the rent freeze. Yeah. So that was abandoned in Scotland, and there's actually legal cases happening there as well against that legislation. And the Greens, of course, who were part of the push for that in Scotland, and the other left of centre government at the time, the Greens, I think they're facing legal action over it. So, so our governments, thankfully, and I was relieved because I wasn't sure that they wouldn't go down that road, the rent freeze road. They dismissed it generally. Even the ACT government, which is a little sort of has that left-wing view of the world, also said, no, this isn't going to work. And that they conceded that it's really only going to be fixed by a sharp increase in housing supply. And, of course, that's the real issue. And as we said, we're getting a flood of demand. So, we can't stop demand, particularly our student demand, because that's an important driver of the economy. So we have to increase supply, and we've got high house building costs. It's not just all the other barriers, red tape, green tape, you name it, all the planning restrictions. But it was also now got high house building costs. But I thought it was interesting. There was a part of that conversation was about increasing investor activity amongst governments. They're actually saying, well, maybe, and this is like, you could have hit me over the face with a dead fish, because it was like, oh, you're kidding. After years of flattening investor activity, treating investors as the bad guys and girls, finally they've realised, maybe we need
them.
more investors. Maybe we shouldn't have been creating disincentives. Maybe we shouldn't have had the investor credit squeeze. Maybe we shouldn't have been hitting them with all these extra charges and levies because we've got this nightmare rental market. How do we fix it? Because we can't build our way out of it.
No.
So I thought it was, and this is the point that, look, and I don't want to get too ideological here, but when you're fixed with some sort of an ideological bent, such as, anti-free market or anti-free housing market, in that sense of free enterprise housing market, which we have here in our rental markets to a large degree because they are all about small enterprises who are risk takers, who provide the great bulk of our rental accommodation. Now, you can't have it two ways to be saying, we want to control the free market environment and still have a happy housing market. Well, it hasn't happened that way. In fact, it's created a mess. All those, wise decisions that were made to get rid of investors or to reduce investor activity, we've ended up now with this, crisis in our rental market. So there is talk now, maybe we should be giving investors some incentives. Like I said, you could have knocked me over with a feather. They said that. And other factors also, Lexi, which I think are interesting, that there's now a focus also on the temporary rental market, the Airbnb market, to try to create disincentives for the temporary market. And I think the Victorian government's now restricting the amount of days that you can have temporary accommodation with your property. And of course, perhaps part of the creating those disincentives, in the past for investors, that they shifted into Airbnb away from the permanents. So what they're trying to do, maybe, and it makes sense, I suppose, is to bring those temporaries back into the permanent market by making it tougher or increasing regulations on the Airbnb market. Now, it may help to offset the shortage that we have.
Just about to say.
And that's part of, obviously the initiatives of looking at increasing investor supply. But at least there's some, light at the end of the tunnel in terms of recognising that we need more investors, more small-scale investors to offset this problem. And we've got to look at, whatever mechanism we can to bring more small investors into our housing market. Because like it or not, ideology or not, that's what we do. 40% of our accommodation are private sector landlords, So you can't keep treating them like crap and expecting it to all work out, hunky-dory, because this is what happens going forward. So let's have a look at the numbers for the rent report. I've sort of got onto a bit of a high horse there of sermonising, but we'll get back to the real data. So Sydney house rents just eased a little bit over the month, still the highest in the country at $750 a week. Wow. Melbourne was up. There's plenty of upside to that Melbourne rental market, I believe, and certainly houses in Melbourne are nearly $200 a week less expensive than Sydney. So, as I've said, plenty of upside there. Brisbane up a little bit. Adelaide also up slightly. Perth and Hobart were flat. Darwin, which is volatile from month to month, up 3.1%. And Canberra up 0.8%. So Sydney was the only one to record a fall in house rents, but still the highest in the country. And when we look at the annual result for rents, we can see some really sobering results there. Melbourne up 18% for houses, Sydney up 15%, Brisbane up 5%. Nearly 6%, Adelaide up 12%, Perth up 15%. Some really strong results there over the past year, which just shows you what a tough gig it is for tenants that have got to confront those sort of increases in their rental costs. Typically, and these, of course, are new rentals. They're not the total rental market, but it all sifts its way through into the total rental market eventually when your lease has to be renewed. Look at those vacancy rates. They're all down over the they're all down with the exception of Hobart over the month, and very, very low levels with the exception of Hobart and Canberra, which are still very low levels. But when we're talking 0 point little, it's seriously, it basically means, there's nothing for rent, tough luck if you're looking for a property, because if you do find one, there's a queue a mile long that you've got to compete.
Yes.
Unit market, Sydney was steady, still the highest, again, clearly for units. Melbourne just eased a little bit, down by 2.4%. Also, Brisbane eased a bit, Adelaide up, Perth up 1.9%. Again, Darwin volatile up 7.8%. So generally rises in rents or steady for units over the month. But look at those annual results. We've got Sydney unit rents up 30% over the past year. That's why you can't keep pushing rents up at that rate. I mean, that's why it doesn't keep accelerating, because people can't afford it, particularly with high inflation and other costs, and having to be covered. And our high rent costs are part of what is still, which works its way into the inflation rate. And it's just not going anywhere. So Melbourne up also nearly 30% over the year. Brisbane up 23% over the year. Big numbers there. Same with Adelaide, same with Perth, although they have smaller rental markets for units. But similarly for the vacancy rates, all fell sharply, they all fell sharply. They all fell sharply over August compared to July. Melbourne's still tracking there at 1.4%. Of course, it was around 6% a year ago, its vacancy rate 18 months ago, and it's coming down. As I said, I think there's still plenty of upside for Melbourne rents, particularly given how strong their student market is. So really no good news there for our rental markets. In fact, it's more bad news. It's showing there are fewer properties now vacant, the vacancy rate falling again, and it'll only mean higher rents, sadly, down the track, which I guess is good news for landlords to cover those what were higher interest rates. But landlords are, importantly want to maintain strong relationships with their tenants. So it's not just about squeezing every drop of money out of them, because that means you tend to get a higher turnover of tenants.
Well, Doc, not to ask an obvious question, but do you think these rent prices would go down if the interest rate goes down? Obviously, you suspect so.
Well, it's just supply and demand. The point with interest rates is it would affect the mortgage market. But what we've got, the problem with our rental market, is we just don't have enough houses. So if you want to put a roof over your head, you've got to pay what the market offers, right? And landlords will ask whatever the market is providing them. Now, if their cost base falls away, that means more with mortgages falling, with interest rates falling, then that means that they have, more profitability. But it offsets the less profitability they've had as interest rates have increased. And a lot of landlords have been doing it tough with higher interest rates, let me tell you. And even the higher rents, haven't completely offset that. So changes in interest rates are more about the profitability of landlords, and doesn't necessarily reflect what happens with rents, particularly on the downside. What we need is more rental properties to put downward pressure on rent. That's the clear answer there. We just need more rental properties, because we're not going to have less demand, because there's no way known we're going to reduce migration. And that's why rents collapsed through COVID lockdown, because we didn't have any internationals coming in, particularly students. So we saw rents collapse in Melbourne CBD and Sydney's inner suburbs, basically because we had closed borders, no students, no tourists, no business travellers. So all those, properties were vacant. And we had all the Airbnbs come into the permanent market, obviously because of closed borders. So the only way we're going to fix it is more properties, more rental properties, because we're really not in a position to reduce demand, and it was always a fallacy that governments had, and policymakers had, that if you get rid of investors, right, let's get rid of investors, right, or reduce investors, we're going to have heaps more first home buyers because they'll take up the slack. Didn't work that way, guys and gals, right? Didn't work that way. In fact, it worked in the opposite. You just got those people who are saving to get into their first home now have a much higher mountain to climb, because they have to pay more rents, and of course, governments have had to offer more handouts for those first home buyers, keep them in the market. So it's cost them anyway. So, like I said, beware. Governments, political parties with particular ideological, views of the world, how it can impact a very settled market environment, such as Australia's housing market, and how you can create more problems than you solve. And certainly I think that's our issue with our rental market. So I'm going to now have a little bit of a giveaway for those that are watching. If you want a copy of the rent report, right, there's the QR code. Get your camera out. Take a little picture of that, or a big picture, whatever you like, of the QR code, and that will give you a link to the rent report, the PDF rent report. So take advantage of that one. Put it on pause. Take a picture, and there's your rent report. So we're just going to finish up, Lexi, now as usual with our weekend auction market report. So as I mentioned, we just had a bit of an easing over the second weekend of spring. Surprisingly tracked backwards our auction markets following what's been a very positive month or two of results and quite consistent results. Listings remained high, so obviously those listings were scheduled a month or more ago, so they reflect the seller sentiment of a while back. But clearance rates were lower in all capitals compared to the previous weekend. Maybe reflects, and this is probably clutching at straws, the commencement of football finals maybe acted as a distraction to buyers, maybe not. Or maybe it was just an easing process as we get from weekend to weekend. But look, and you would have thought the pause in interest rates would have been a positive for the market. Another pause would have been a positive for the market as well in terms of sentiment. But it is what it was. It'll be interesting again to see what happens this coming weekend. So everybody watch next week to see if it's, is this the beginning of the end, or is it the end of the beginning? I don't know. But what were we going to say, Lexi?
Sorry, Doc, I was just going to ask you, do you reckon people are maybe waiting, another pause? Maybe it might start going down, interest rates. People are a bit too hopeful, perhaps?
Well, I'm not. I wouldn't hang your hat on interest rates falling anytime soon. In fact, that would be a bad news story, not a good news story. I think there's still work to be done to cure inflation. Our economy is still very, very strong. Our inflation rate is still well above double the target range. So, as I said, the Reserve Bank's still got some work to do. Yeah. It's trending down inflation, and it's prepared to wait. It said it doesn't believe inflation will get back to the target till the end of 2025. But I don't think it would be risking putting down interest rates to then risk putting up inflation, because that would obviously create more spending capacity with lower interest rates. And that would mean maybe, hey, we're back into this higher inflation. I'm not sure they could really support it at the moment. So I'm not sure. I don't think we're going to have to worry about lower interest rates, for a while. And let's understand that our interest rates now are still about 1% below, or the best part of 1% below where they were at their previous peak in 2011, 2012. Yeah. So it's actually historically quite a low interest rate still, although, obviously it's relative to the current conditions in terms of household budgets. But I don't think we're going to have to worry too much for a while about lower interest rates, which actually are sort of a bad news story, not a good news story going forward. We need to get inflation under control. Yeah. And with issues such, particularly the price of oil is now rising again. It's crept up to around $90 US a barrel. It was under $70 US a barrel. It's still below where it was a year ago, they were crazy high prices then. Yeah. But eventually it's going to catch up with, the fall. And most of the fall in inflation, headline inflation, has come from the fall in the price of oil, right, compared to a year ago. So, that's not because we've had oil prices falling sharply from that $123 a year ago at its peak. Eventually, if we see it rising again, it's going to work its way back into inflation. And we know that when we look at the price of petrol at the pump at the moment, it's above $2 a litre mostly everywhere. And, the low Australian dollar, and that's because our interest rates are higher than overseas. Yeah. But it just means we pay more for petrol, and that's not good because that will fuel, extra costs, through transport costs and other bits and pieces where people have to cover higher fuel costs. So I think that there are issues. I'm rambling on a bit now, but there are issues that will act to constrain any thought of a cut in interest rate. We've just got to maybe be a bit wary of another rise coming along, but we'll see how that pans out with the data. So these are results from Saturday. Another big number of auctions in Sydney, 745 auctions, down a little bit from the weekend before. And the clearance rate was actually the lowest since July for Sydney. So that just shows you how well Sydney's been tracking. Still a good result. Over 70% clearance rate is still a result in favour of sellers. But it was the lowest we've had in Sydney since July. So something to think about there. Melbourne, another big number of auctions in Melbourne. In fact, it was the highest number of auctions on a Saturday Melbourne's had so far this year. It tracked back a little bit again. Melbourne's just been a bit softer over the last month. It's sort of been tracking around about 70%, coming down from the mid-70s. But lots of auctions there, so I guess maybe more choices for buyers. And we've got to understand that we're in catch-up mode in Melbourne and Sydney. When we look at the price models, house prices are still below where they were a year or at the beginning of last year at their peaks. So eventually that'll run out, that sort of value opportunities for buyers once we get back to peak prices. So a lot of this is catch-up demand, which has offset the higher interest rate constraints, but maybe we're starting to see a lot of that demand now being satisfied, and also the impact of higher interest rates just chasing away a few buyers. Brisbane, we only had a small number of reported auctions in Brisbane, even though it had 52 there. So that was a little bit of a volatile result. Adelaide was also down a bit, strangely for Adelaide, after having a 90 the weekend before. It was down under 80, which is a little unusual for Adelaide. And Canberra was also down a bit with fewer auctions. So just a little bit of an easier weekend there. Just a heads up, Lexi, we have our first Super Saturday of spring in a fortnight. So not next Saturday, but the Saturday after will be the first Super Saturday. Oh, sorry, the next Saturday. I'm getting ahead of myself. Not this coming Saturday, but the following Saturday will be the first Super Saturday of the spring selling season. And typically because the Super Saturday is all about avoiding the clash with the grand finals, the football grand finals. So agents always avoid that weekend for auctions. So the weekend before is front-end loaded, if you know what I mean.
Nuts.
So everybody has that pre-grand final surge in auctions. So we'll get a very big number, well over 1,000 auctions, likely well over 1,000 in Melbourne, and likely around 1,000, maybe more in Sydney. So that'll be a big challenge for the market, Lexi, to see whether they can those clearance rates can hold on with what will be a very big auction weekend in just under a fortnight's time. So they're the results. And when we look at just easing a little bit September with those results, last weekend for Sydney, this is the monthly results, but still tracking at reasonably high levels, good levels there for sellers generally. Melbourne down a little bit, as I said, just eased over the last month or so, the Melbourne market. Brisbane was a volatile result, so we just need to take that one with a grain of salt and wait for this weekend with more results coming through. Still a high number there with Adelaide because, of course, it had a 90 plus and then under 80. So when that's put all together, you get 89%. And Canberra just down a little bit as well. So what we're going to do is just miss that one out and move through here. So all those auction clearance rates, just forget that slide. Those auction clearance rates are available every Saturday night on my LinkedIn channel, Doc Andrew Wilson. At around about 6:30, you can get the capital city results. And then on Sundays, typically Sunday morning, you'll get the National Auction Market Report, which includes regional breakdowns for Sydney and Melbourne, and some commentary on that one. So as we always say at the end of the show, Lexi, we have a giveaway here for all our viewers, and that's our My Housing Market Infinity app, right? How much is your house worth? Well, this is how you find out, because you get onto the app right? The app will then tell you the data for every suburb in Australia that has data, and it will tell you what the current asking price is, the median asking price, the high asking price, the low asking price. It's not just the median, it's the high and the low for each suburb. It will tell you how many listings there are, so how many properties there are for sale. It'll also give you the same data for rents, so you can also find out what rents are being asked. And you can also filter it, not just on a suburb basis, but you can filter it for house, unit, townhouse. So you can filter it for that. And you can also filter it for the number of bedrooms. So you can look for 2-bedroom, 3-bedroom units, 4-bedroom, 5-bedroom, 6-bedroom houses, and it will filter and give you that information. So a nice little guide, a little tool set if you're looking for selling or buying, to tell you what the market's offering right here and right now. So you can get that through that QR code there. Again, that will give you the link, but it's password protected. And the way you get hold of that password is through Infinity. So it is part of the Infinity Group's offerings to its clients. So get onto Infinity and they'll be able to give you the password, and you can take advantage of a great little app there. So that's all for this weekend and for this week. And we look forward to next week, where we have a particular interest, obviously, the auction market again. Will it hold up? Will it continue to fall? And we also have the unemployment data for August, which comes out this week. So that's going to be interesting to see. Because we've been tracking between 3.5 and 3.7% our unemployment rate, which is very low. It's a question of whether will we go back to 3.5, or will we go higher than 3.7, or will we be at 3.7? And this is interesting data, particularly for the Reserve Bank prognostications. And what we'll also have next week, Alexi, will be some early insights to what's happening with house prices so far over September.
That'll be good.
So I'll have some early insights into that. So lots of information, lots of data that you can use as a guide for your property decisions.
Yeah.
And as we always try to do here, we try to offset any of the negativity, and there's plenty of it out there.
Yes.
You know,
it's not all doom and gloom.
But there's no doom and gloom. None. Nada.
None
nothing.
whatsoever.
None whatsoever. So it's all pretty good, you know, but it's never all good. But it's pretty good at the moment. And we move on. And as I said, it'll be interesting to see what happens with our auction markets this weekend, and interesting to see how that what happens with our unemployment, with our labour market, which has just been looking a little softer. Well, it did last month, but it was stronger the month before. So whether it's a bit up, down, up, down, up, down, we'll see again this weekend. So great to have you today, Lexi, on the show. And
thank you.
I look forward to a repeat performance next week.
Absolutely. Yes, I might boot Graham out and do it again.
Why not? Who needs it? Yeah, we not? But
when in Rome.
All right. Good on you, Lexi. Have a good week.
Doc. Thank you. You too. Have a wonderful day.
Thank you. Bye.
Bye.